Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a joy. What we did today is we're going out and getting all of our guests who, when they were undergraduates, it was 23 below zero, like at Niagara University, and they had to fight their way from the dorms over to class at 8:02 a.m. for an exam.
Very true.
I was at RIT. I mean, it was just, this is Rochester, folks, Western New York. It's right now, it's like the second week of March for me and Joe Quinlan.
That's right.
Joe, I read a Zero Hedge had a great summary, one of the banks, Bank of America, I don't know who. And basically they said retail stepped in during the Trumpathon in Davos. What does it mean to investors or to our confidence to invest in our 401k if it's just retail stepping in, fear of missing out?
I mean, they are stepping in, Tom, and they're buying the dips. But, remember, there's $7.7 trillion sitting on the sidelines. Not all retail institutions, but our clients are looking for those dips. Honestly, they're waiting for them, and they're stepping in, and they're hitting singles and doubles.
Is this a new thing, or was it like this in the 60s or in eras before?
I don't know if it's a new thing, Tom, but I think there's some confidence out there that longer term, despite all the headlines, the dramas, what's happening in Washington, they like the companies, they believe in technology, they're spreading their risk around small caps. So I think it's a belief that despite Washington, the real economy's in good shape.
Paul, you told me to go into small caps. I didn't listen.
No. So, Joe, what we saw a little bit in 2025 was, as well as the U.S. equity indexes did, a lot of markets outside of the U.S. did a lot better. How do you think about the U.S. versus non-U.S. these days? What are your clients telling you?
I mean, we still like the U.S. I think the U.S. had an off year. It's kind of like, the Boston Celtics, one of the greatest dynasties out there. They don't win every year. But the U.S. economy is part of our core portfolio holdings, the equities. But we do like overseas, whether it's China tech, banks in Europe, defense plays in Europe and South Korea, Japan. So the breadth of opportunities for retail institutional investors has broadened. So it's just not about the Mag 7. It's not about the U.S. equities. It's broader, and that's a good thing.
What are we doing in the bond market here? Because, again, 2025 was a solid year for folks who held bonds, high single-digit total returns. How about 2026?
2026, we're shorter durations. We like corporate bonds. We think 10-year yield, our interest rate team is looking between 4.25 and like 4.50, 4.75. So a tight range for the 10-year yield. But, that could change given what the Fed's next path for cutting rates, what's happening in Japan. So there's a lot at stake there.
Joe Quinlan with us, folks, head and CIO Market Strategy at Merrill and Bank of America Private Bank. As Alexis mentioned, your 5,000, Paul, 4,934, up $21 on gold. Paul?
Let's go to gold. I mean, that thing, gold, ripping, silver, ripping, all the other precious metals ripping. I mean, who's buying all this stuff?
Retail institutions, and in particular, central banks. So you are seeing some dollar hedging out for investors. So we think that's going to continue. Central banks are diversifying. We're seeing a lot of clients. That's one of the first questions they ask. How much gold should I own? What else should I own? Silver and so forth. So that's going to continue. And if you look at the grid, the build out, that we need all these precious metals and base metals on top of the defense outlays, there's a lot of upside yet for commodities.
I mean, here's one of the issues. We're getting right smack into the teeth of earnings season right now. 2025, solid earnings here, a low double digit. Is the earnings outlook for 26 enough to support this market here?
Short answer is yes. Longer answer is look at what these companies are doing in terms of pivoting, using artificial intelligence, robotics, rejiggering their supply chains. You've got a good consumer behind them as well. So I think the earnings estimates, double digits again this year, will be supported by the U.S. economy. It'll come up behind it. So, and it's really the management of companies across the board that will help driving earnings.
Well, I mean, I guess a lot of that earnings growth is coming from, not surprisingly, the big tech names, the Mag 7, if we want to use that nomenclature, or just big tech in general. I guess big tech is going to lead us again in 26?
Or next week as well.
Or next week or this year, but not as much as last year. Big tech earnings year over year are coming down, but that's okay. Because the other parts of the market are coming up.
Julian Emmanuel this morning, he's modeling right now, and it's going to change, folks. Yep. Ready? 14.4% earnings growth.
Yeah.
Is his model guess this morning.
Yep.
Unbelievable.
So what do we do here to the extent we want to, rotate out, broaden, try to find some breadth in this market? What do you?
So you're suggesting rotate from NVIDIA to Microsoft?
Exactly, maybe.
No. We've been looking at small cap for quite a while. We like the cyclicals, whether it's financials, materials, metals, industrials. Some of the old economy stocks that we were accustomed to, they're becoming more technology enablers and adopters, and they're going to surprise folks to the upside.
Okay, Nixon was president when you walked into Merrill Lynch, Pierce, Fenner, and Smith. Joe, let's cut to the chase here. How long does this song and dance keep going? I'm talking, Anna Wong was in yesterday. She's definitive. And the answer is, we got pop in real GDP and massive pop in nominal GDP, like the 4th of July. Does Joe Quinlan go into 2027?
Yes, Tom, because the average bull market is typically 5.5 years. So we're like not even 3.5 years into this bull market. I see this in the 27 and 28, right? Because we have a lot of
just because of oomph.
Tom, think this is our economy right now is expanding faster than China's.
Yeah, thank you.
Plus. And so in the earnings, we go back to that ball. It's so supportive that. So we've got a lot of energy. Economy, the stock market, the animal spirits that takes us into 26,
okay,
27.
But you studied this at Fordham University, which, folks, is expert on this in international economics. Okay, so we have a nominal I did this with Darter, Paul, the other day. We have a nominal GDP popping like China.
Yes.
But we don't have the same economic structure as well. Do we embed a permanent inflation because we don't have the supply-demand dynamics of a 7% nominal GDP?
I think the inflation number, Tom, is closer to 3% as opposed to 2%. Okay. But I don't think it has to bust through 4 or 5% in that sense. And that's the sweet spot. Nominal growth, 7, 8%. That's perfect for earnings. A lot of companies can do a lot of
It's un-American. Move to Beijing. Paul, get one more in here.
Joe, what's the discussion you have with the Merrill and BofA private bank clients about alternative investments, private equity, private credit, hedge funds? And what's an allocation that you think is reasonable for?
More of our clients are looking at that, particularly private credit, private equity. They like what they see, the opportunities. There's a lot of good companies that are not publicly traded, so they want to have access. But they're moving slowly. They're still looking at bonds, stocks, cash, private equity. So the conversation has started. They're putting money to work, but they're being careful.
This is wicked important. Paul's brilliant question here, folks. To me, in the zeitgeist that blooms off the rose, every marketing type on the 14th floor 90 days ago was private credit, give me a P, give me an R, cheerleading on. Paul, do you suggest it's a little bit like the demand for private credit in my IRA is maybe not there?
I don't know, Tom. When we go visit some of these RIAs out there, I'm shocked at the allocation that they do have for alternatives. I would have thought it was 3%, 5%. No, they're talking 10, 20, 25%.
Really? It's moving higher, for sure. There's no doubt about it. But I think it's going to stall out at, say, 10, 15%. It's going to be a show me. It has tax ramifications, the paperwork that comes with that, the tranches, the tie-ups, and so forth. So there's clients that really embrace it. But the general, it's moving higher, but not close to 15, 20%.
When you talk to Brian Moynihan, when he's back fancy from Davos, what do you say to him about the state of buying the stock market?
Well, you saw our bank earnings pretty robust last year, the year before. We're looking at another good outlook this year. Our Bank of America Institute is a data gatherer. We're an 80 million household here in the U.S., Bank of America. So our data is suggesting good consumer, capital investment is strong. Our commercial book is strong as well. So Brian, econ team, the CIO where I work, all pretty positive heading into 2026. It's a good story. And people don't believe it, but it's a good story because they're
on Friday night at Niagara University. What do you do? Go over to the American Falls?
Well, no,
you go to the freshmen. You go to
the Rathskeller, lock the door, and make sure the kegs are full.
Okay, thank you, Joe Quinlan. Thank you for that important strategy advice. He is, of course, legendary at Merrill and Bank of America private bank. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Say she's with JPMorgan Asset Management barely describes an eclectic track record. I love the idea, folks, that you prepare for fixed income, currency, and commodities by spending 17 years in equities. You are a strange beast, Herr. What is it like moving from equities over to FICC? I mean, that's a rare thing.
So I'm going to take that as a compliment from you, calling me a strange beast.
I mean, it's really, really a different path, isn't it?
And I would have thought you would have been in Davos this week while I was toiling away at 270 Park. You're not out there wearing fancy sunglasses,
No, I did it for 20 years, and, John went, and, we sent a whole bunch of people to Bloomberg House and that. But, frankly, I get as much done in Davos sitting here as I do sitting at the Belvedere. What are you nodding your head about? She knows
true.
I'm
You
at the
don't get
Belvedere
anything
Hotel
done
bar.
there. So look, to answer your question, look, I love investing. I love thinking about what's priced into markets, and investing is fundamentally about projecting future cash flows. So the major difference between, I started as a credit research analyst, spent 3 years as a credit research analyst, then spent 17 years in equities as an analyst and a portfolio manager before moving back to fixed income, 6-7 years ago. And the real fundamental difference, Tom, is upside or downside. And so in equities, you get to dream about things going up 10 times, sunglass makers going up 60% in the week. Bonds were a little bit more boring basis point to basis point, not losing money. So I guess I'm a little bit better about thinking about downside risk than I am about blue sky, blue sunglass scenarios.
Geopolitical risk kind of came back to the fore again this week. Kay, how do you guys think about that? We had to deal with it in April of last year, came back a little bit this week. Do you guys just try to see through that?
It's a great question, and we got to separate it into two pieces. So when we're managing portfolios, you've got to see through it and look to see, are there any opportunities we can capitalize on? If you take a step back, though, and you think about the backdrop heading into Davos, we've got relatively low volatility in the equity and bond markets and relatively high valuations. And so you introduce a little bit of geopolitical intrigue, and there you've got some volatility in markets, and that tends to pass along. You think about the bond market this week. The 10-year Treasury had been kind of range-bound between 3.75 and 4.25 for a while, edging towards the lower end when we get weak employment number, moving back towards the higher end when we get concerns about inflation. And we broke through that this week with the geopolitical tensions. When you look at it, breaking through the 200-day moving average, which was 423, there's not a lot of technical support. And when you start to worry about, I don't think that invading Denmark was on, or I'm sorry, invading Greenland, not Iceland or Denmark, was on anybody's bingo card. So that kind of comes in and makes people very volatile. And we've got an absence of fundamental data until the next employment data, until February 6th. So people start to move into conspiracy theories and concerns about geopolitical. But the answer to your question is yes, the fundamentals are what's more important. And on the fundamental side, what we see is a no hire, no fire market, moderating inflation, and pretty solid economic growth. You saw GDP yesterday at 4.4.
How much credit risk are we taking in 2026? I mean, you consider a 2-year Treasury and get 3.6%. That's not bad.
Yeah, so we like high quality credit, both high quality investment grade and high quality high yield. And, as I was sitting here listening to the meteorologist, which I think this is the first time I've ever been preceded by a meteorologist on Bloomberg, I was trying to pull this together and what are the themes. And Tom, this one's for you, really. The last major snowstorm the New York metro area had, to my recollection, was 1996.
That was a big one.
Credit spreads in IG are back to their 1998 tights. So we're going back to the 90s this week.
There's a heritage at JPMorgan on gold. You made a splash middle last year on a 5,000 statistic, which is happening way faster than you thought or anybody else thought. But bring over how you think gold should be an adult, responsible retail, even institutional family office portfolio. Do you buy Broken Hill Properties of Australia? Do you put Krugerrands in the bedroom of the third house, the dresser drawer? What does Herr say you do if you say, I guess I need to own gold?
Look, I think if you guess you need to own gold, I think the biggest change in the market in the last few years is that ETFs have made that more accessible. So I guess I'm an old-fashioned buy gold jewelry, buy gold coins, but I think for the average person, maybe it's more accessible in an ETF type structure or something like that. But I think one of the things that's driven the increase in prices in gold is the creation of the new ETFs in that market and the accessibility for gold. And as I'm sure you know, there hasn't been the supply of gold hasn't really changed, and the demand for gold has risen. So I think that's what's really driving it.
2025, we started hearing a lot more, at least I did, about emerging markets and the performance there. Give us your view on emerging markets these days. How are you playing it, if at all?
Yeah, a couple of things on that. Yeah, emerging markets really rebounded in a material way last year. I think a couple things. When you think about the emerging markets, first off, I mean, as we've learned over the last couple of years, developed market central banks forgot about inflation. Emerging markets never had the luxury to throw out the inflation fighting. So emerging markets were much quicker to start hiking rates before inflation got carried away. And increasingly, they've shown more fiscal discipline as well. So when you look at EM versus DM, you're seeing, a growth pickup in emerging markets on the order of 2.5% above developed markets, and that's a pretty attractive opportunity.
New issuance has been crazy in the fixed income space on municipals, investment grade, high yield, and I don't know, if I listen to the Jamie Dimons and the Moynihans of the world, it's going to be even more so in 2026. How do you guys as investors deal with that? Because I would think that would be a challenge or a headwind for performance.
So it's really interesting. If you look at the investment grade market, we've had $170 billion issued from Jan 1 through this week. And as you probably would expect, and I think the first 2 days of the year were record. So market really came out in force with a lot of issuance. But I think it's really interesting to think about the fact that in the face of record or near record issuance, you've also seen a tightening in spreads. So, we've heard talk this week about the Sell America trade. Instead, what we've seen is record demand for these types of, and a tightening in spreads. So in terms of the question, and I think about 26 and generating investment performance for our clients, I think there's likely to be more dispersion in performance of different credits, and I think security selection is going to be very important. So I think that's what we are really focused on. But I think because of the geopolitical situation this week and the fact that some issuers are in blackout, it's been relatively quiet this week. I think it comes back in force over the next couple of weeks.
We got sub 100,000 job formation. There's 8 different opinions on the job market. Michael Ferroli with path making work on potential GDP even a decade ago, 8 years ago. And yet we've got this boom real GDP, this boom nominal GDP. Do you say to your clients, look out past the 2026 stimulus? Or do you say this is part of the new America where you're going to have a greater animal spirit from a buoyant nominal GDP?
I worry about saying in the investment landscape, one of the most dangerous expressions ever is this time is different. So I worry about that. But I do think that what we've seen is an enhancement in productivity. So on the topic of Mike Ferroli, he's an outstanding economist. I've got a lot of respect for him. And the topic of the broader economy, I mean, it looks pretty solid across. It continues to be a K-shaped recovery for consumers. It's not equally spread across people. But I do think we've got some fiscal stimulus this year, an administration that is looking to enhance animal spirits. I think you're absolutely right on that.
How far I got 8 ways to go here. How far behind retail is institutional? I saw something yesterday that once again they under-own tech into earnings. Julian Emanuel publishes at Evercore ISI this morning a 14.4% earnings growth run rate. Maybe it's there, maybe it's not. We'll know in 2 weeks, 6 weeks, whatever. How does institutional catch up to this retail success in technology? Do they need, is it just simple? They need to buy more Apple? Don't give me this. It's outside your remit. You did equities
I'm giving you
for
the gosh.
17
I really
years.
don't know how to answer that. But I don't know that. I don't know that that's. I don't know whether the premise of your question is accurate or not. I don't know that retail is ahead of institutional. I think, you look at funded status and pensions and things like that. I think we've had some very successful institutional investors. So I don't know. Is my answer.
Okay.
How about earnings? We're getting into the teeth of earnings next week. I think at 300 of the S&P 500 companies report. Is the earnings outlook sufficient for markets, do you think, these days? Or do we have to earn our way into some of these valuations?
It's a good question. I think what you've seen so far in earnings season is that disappointing earnings have been punished severely. Mm-hmm. So I think it depends on the valuations. I think for the bond market, yes, spreads are tight, but I think earnings have been good enough and they'll continue to be good enough. I think in the equity market, where some of the valuations are a bit more stretched, I think companies have to put up numbers that show that they warrant those valuations.
Thank you so much for coming by.
Yeah, thanks for having me.
Lovely to have you here. She's with JPMorgan. Folks, can't say enough about the cross-asset work that Herr has done for years. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
She's incredibly qualified at Morgan Stanley. Monica Guerra joins us, Executive Director, Head of U.S. Policy at Morgan Stanley. There's a stimulus, Monica, going on right now. Alexis is going to get like six $2,000 checks or whatever, the way she's playing the game. Monica, does the stimulus go over to our infrastructure investment in America?
What we're thinking right now is that it's likely to go actually to the defense industry. You had, Trump request a $1.5 trillion defense budget. This is a 50% increase over the prior year, the largest year-over-year increase since the Korean War as a percent of GDP. So while we're not saying this is wartime, it does indicate how involved we are on so many geopolitical fronts. And that's really where the economic multiplier is likely to come from the fiscal side in 2026.
Monica, it's an election year yet again. What does that typically mean for markets here? Because, oftentimes in these, midterm elections, you get a change in controls in various houses of Congress. How do you play that?
So midterm election years, markets tend to underperform, and it's the year after that you get the outperformance, and that's because folks are waiting to see, right, that outcome. Typically, what you'll get is if we end up with a split, gridlock Congress in 2027, we're going to be off to the races, right, because nothing changes and policy is stable. But right now, we're in that policy uncertainty mode. The one thing we do know we're going to get is that focus on affordability and the Trump administration keeping the midterms as part of every single conversation that they have. And one of those things is we're going to be seeing it in housing, trying to control energy costs, as well as making other aspects of spending and the consumer affordable.
But if I get out my Rolodex, you're one of the best people to talk to about well-intentioned politicians, quote, trying to control. Is there any history that politicians can control Paul Sweeney's electric bill?
I think it's challenging to do, but one of the things that they're looking to essentially alleviate the burden is to essentially move from this idea that there's an energy transition happening to an energy addition, and trying to make the public-private partnership component on the muni side more accessible and easier for municipal bonds to come to market in the public power space, giving the municipals and the local governments more power to have over their energy sources. So this is a long-term play. It's not going to be overnight. And for the midterms, it's likely to be more messaging on energy costs versus an actual reduction.
Monica, I guess just this week we saw some of the volatility come back into the market that maybe we saw early last year. So it relates to tariffs, this time associated with Greenland. It seems to have tampered down here, but do we have to start thinking about some of this tariff stuff and crosswinds, headwinds for the markets?
Yeah, I mean, one of the things that we've, long held is that the, tariff environment is here to stay. Even if IEEPA is struck down by the Supreme Court, which we think it will be, the administration is doing all the legwork in the background to set up certain backfills, if you will. So Section 232, Section 201, there's tons, right, of different categories of trade law that they're exploring to try to essentially create a patchwork to get us to that final place. The other option that people aren't talking about with IEEPA is that we could end up in a gray zone where you get a nuanced carve out on tariffs.
Right.
So for example, you could say, okay, we could justify China because you can argue that we're in an economic Cold War with them,
right.
But you can't for Malaysia. And so then that even makes it an easier case for supporting that federal debt and deficit in the budget.
If they lose, is Alexis going to get a tariff rebate check for the bananas she bought 90 days ago?
So,
I'm waiting.
All right. So this is going to come full circle to my first comment about defense. So if we're thinking about that significant amount of fiscal spending that could be coming for these defense and geopolitical priorities, in our view, it really lowers the likelihood that you're going to get an appetite for a rebate check for your tariff.
Well, pick me up,
so
please.
we think that's highly unlikely. Highly unlikely you're going to get that check. But rather, they're going to try to come at the affordable piece through, other measures.
That's kind of it. I mean, affordability has kind of really come into the top of the discussion pile here, given some of the elections we saw in, New Jersey and Virginia and some others. Is that something that you expect the administration to focus on?
Absolutely. And one of the things that's important, though, is that even though Trump's, proposing, say, a 10% cap on credit card interest, it's going to take an act of Congress to move a lot of this along, which is helpful for members of Congress that are, running. We don't know exactly what's viable because there's still a lot of infighting and sort of, setting the table for 2026. Right. But we're going to see more and more of this discussion because it is going to be a winning category on that campaign trail.
Monica, thank you so much. Great brief, terrific brief. Monica Guerra at Morgan Stanley. Again, we protect the copyright of all of our guests. Get her wonderful, important research from Morgan Stanley. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
She's toasty warm, and she has been working on the newspapers. Alexis Christoforous with a set of ideas.
Yeah. How about this for breakfast, guys? A pint of Guinness with some complimentary donuts. How's that sound?
Perfect.
You know who's doing it?
Who's doing it?
JJ Foley's up in Boston. They're calling out all the Patriots fans who want them to at 7 a.m. How about a Guinness? 7 a.m. They want you to come on down to JJ Foley's there in the South End because the Today Show is going to be there.
Is this today?
Live. This is today.
Oh, my word.
So grab your hat and your scarf and your sign and go down there because they want to send off their Pats to the game on Sunday against the Denver Broncos in style. So, you're going to have Pat the mascot's going to be there. Nice. Pat cheerleaders are going to be there. And they're promising some beer, some free Guinness.
It's South End. It's it's not South Boston. It's sort of South End. But it's not. I can't see the Today Show at Tom English's. They just
they just don't mix.
JJ Foley's more upscale, so it'd be
Yeah, they're the oldest Irish pub, I think, in Boston.
Is that right? It looks cool.
I was going to say the Western Hemisphere. What do you mean it looks cool?
Looks great.
There's a brass plaque there from 3 lives ago.
There you go. Exactly. There you go.
Maybe
Good morning, 92.9 FM in Boston.
Sure.
Absolutely. Yeah, we love them.
Next.
Hey, okay. I'm going to move on. I was going to say that I was hoping maybe the Pats can win on the road this weekend because the Broncos QB's out with that ankle injury.
That could happen.
Yeah, but somebody had a map. The entire nation's for the Denver Broncos.
I know.
Except for 3 zip codes in Boston.
All right, listen, if you don't want Guinness for breakfast, how about biscuits and gravy? Here in New York City. I know that bagels are our big thing, but there's a chain down south. I don't know if you know it, Bojangles.
Sure.
So it's going to be opening up its first location in New York City. It's going to happen in Flatbush, Brooklyn.
Of course.
Of course, whatever that means. And they're hoping that biscuits can become the new bagel for folks in New York. So the menu includes bacon, egg, and cheese, sausage, egg, and cheese, chicken sandwiches, but they all come. Here's the clincher on buttermilk biscuits.
Yep. get a little gravy, sausage gravy on there, we're set to go.
Yeah. Breakfast is big business, though.
Yep.
I mean, it's becoming big business for a lot of these restaurants because you've got, people are becoming more selective about what they're spending their money on. You've got higher prices. So they're, breakfast is emerging like a big opportunity now.
Absolutely.
All right.
That's a good one.
Okay,
Speaking of prices, so we're talking about this storm. This is all that we're talking about. And of course, unfortunately, we are seeing price gouging, right? They're getting you where it hurts, no matter if you're trying to buy, ice melt, boots, flashlights. So there's this.
I don't understand why people do this. We're going to be
It's horrible.
We're going to be inside for a day. I mean, if that.
Oh, you mean why we're
why
stocking
people go
up?
nuts? I mean, the ShopRite in Belmar, New Jersey yesterday was a war zone. And we just drove right past it. Not even
I give into it, though. I am guilty of it.
Yeah.
I was texting my husband just a few minutes ago. I said, please go get eggs, milk, bread.
You have
Buy
eggs,
it
milk,
all.
and bread in your house already.
I do,
don't get
but
this.
I want more.
But there is price gouging going on, and there's not a way to protect
All
it.
right.
For example, in New York. Or
Yeah. So the New York Post actually did a little deep dive here, an expose. They went on Amazon and they checked prices. They saw women's snow boots jumping 91% in price in just 3 days.
Wow.
Space heaters, flashlights, first aid kits. There was also Petra Pet Safe ice melts. That's hard to say.
Yep.
Climbing 45% just this week. So, folks, be careful out there when you're buying because you're going to be you're paying a premium at this point. There are states though that have laws on the books like New York,
Right.
I think South Carolina, North Carolina, that you cannot just go out and charge whatever you want. But look, when you're desperate, it's hard.
But there's not. I mean, the way you rock, Alexis, is Wagner. I mean, there's not. The Cara ski jacket in orange and purple for $2,000. They're not raising the price on that during this.
No, well, you're a big spender, Tom. So
Well,
most of
it
us can't
says
do that.
Alexis to me. It says low stock.
Okay.
They've already got that.
Run, don't walk.
The newspapers. Thank you so much, Alexis. There.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.